The journey of building your wealth is promising, but you should avoid some simple mistakes that could prove costly. Let's understand some of these common mistakes that investors make. Lack of discipline in investing. The urge to wait to make purchases at the lowest price or to sell at the highest price may cause a lot of stress, as nobody can accurately time the market. Instead, use that time to make a sound financial plan, which includes thinking about your financial goals, understanding your risk profile, and deciding appropriate asset allocation for yourself. Don't get swayed by short-term market movements, and don't always keep following the market hoping to identify the best time to invest. When it comes to investing, the best time is always right now. Mismatching risk profile and time horizons of investments with those of your financial goals. Investments must always be made after taking into account your risk profile and the time you have available to achieve your goals. A lower risk profile must be handled with an asset allocation more biased towards fixed income or debt instruments, while a high risk profile investor would be comfortable with a higher bias towards equity. Also, debt investments are preferred to plan for short-term goals since they are low on risk. Since equity investments offer the potential for higher returns over the long term, use them to plan for long-term goals such as for building your retirement corpus. So if you make investment choices having taken your risk profile into account and also evaluating the time horizon involved in reaching your financial goals, your decisions would definitely be much smarter. Relying solely on recent performance. Top 10 lists based on past 1 or 2 year performance may sound tempting, but be cautious. This philosophy of investing can be a recipe for disaster, as past performance does not guarantee future results, and more importantly, when it comes to markets, things can change very frequently and securities that performed yesterday may simply not do well tomorrow. Therefore, making investment choices singularly on the basis of short-term returns is not a good idea. While short-term returns do obviously mean that the product has done well recently, you should also consider returns over multiple time horizons. Compare performance against the benchmark and against other similar or comparable products to take the right decisions. Also, check if the fund manager has changed recently, and if so, consider his previous track record and his overall investment philosophy. Lack of balance in your portfolio. What if all your investments were in the equity markets and that they underperformed for a prolonged period of time? How would that make you feel? You will of course want to be upset with the markets, yes, but it's not the market's fault that you didn't balance your portfolio with the help of other asset classes. If your portfolio is too narrow, you will not be protected from the possibility of underperformance or poor returns. This is a common mistake which can be easily avoided by diversifying into investments and asset classes that balance each other out. Over-diversification. Now, as you're already aware, diversification is necessary to reduce the risk you may get exposed to. But if your investments are spread too widely over a number of assets, you will not achieve optimal returns as a whole. Even if you've made great returns on a particular investment, it won't be meaningful to you, as it now may be a very small part of your portfolio. Yes, the risks are fewer, but over-diversifying can also lower your potential to gain higher returns. When it comes to equity mutual funds, for example, avoid the tendency to invest in 10 to 15 funds. Instead of buying a carefully thought of selection of stocks, you may end up buying small percentages of all the stocks available in the market through the different funds. That's not very smart, is it? Falling prey to get-rich-quick schemes. Some companies promise returns much more than what's on offer from other similar companies. You should always assume that when it comes to investing, if something sounds too good to be true, it probably is. Get-rich-quick schemes should be avoided, as they are unlikely to deliver. Even if there's a small chance they could give you great returns, we would advise that unless you've done your research and have done proper due diligence before investing, don't take the plunge. Emotional responses to events leading to impulsive decisions. Very often, our emotions come in the way of sound decision making. For instance, when markets fall, many investors, due to negative sentiments, redeem their investments and stop their SIPs in equity mutual funds, as they feel the markets may fall even further. Sticking to their original plan, which would have made them actually invest more at the lower market level, would have been a lot more beneficial to them over the long term. Then the other case is when markets are rising, and many people invest more at higher levels, expecting markets to continue to rise even further due to prevalent market euphoria. In fact, some even wait to see if the market levels will fall again just a little bit to invest, ending up missing out on current opportunities. These decisions are based on emotions and should be avoided as far as possible. We also see herd mentality among investors, which leads them to take decisions such as buying a stock just because others are doing the same, while also abandoning good decisions midway through just because they see others around them responding to market movements adversely. So learn to be the smart investor by ignoring any emotions arising from market events and taking investment decisions only based on thorough research and sound thinking. At the end of the day, it's your own hard-earned money, so please be smart with it. Be cautious of these red flags and avoid them while investing. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.